In Frances Donald. She's chief economist and strategist at Manulife Investment Management. Frances, it's great to have you today. And you think they're ultimately going to have to back down here?
I think we're still going to see rate hikes, but not as many as the market or the Fed currently hopes for or is priced for. Look, when we mark to market, you're absolutely right. Jobless claims very strong. Levels of PMIs look good. We had energy come back, which is a little bit why those inflation break-evens have come down. But we're not in the business of marking to market. We're in the business of knowing what's going to happen 3 to 6 months from now. And when you look at the leading indicators for where the U.S. economy is going, it's going into a material growth slowdown. From housing to fiscal headwinds to real wages declining, consumer sentiment being quite low, that's not consistent with a bullish reflation trade. It's consistent with a consumer that's saying prices are too high, I need to pull back, and a Fed that's going to have cover to say we don't have to go as fast as we were thinking we would have to go. Inflation is moderating. Growth is now a bigger component of that decision-making function.
You know, I hear what you're saying. We heard similar talk from Cathie Wood this week again when she's saying the Fed is risking tightening into a slowdown. She cited consumer sentiment. She cited what we heard from companies like RH, the expected deceleration in auto sales and all the rest of it. But here's my question. All of the consumer disappointment, let's call it, and frustration is coming from high inflation. So doesn't that mean the Fed cannot back away here or they're going to make the problem worse?
Well, here's the challenge with inflation. We're changing the nature of inflation as it goes forward. Headline inflation is going to decline, but we're moving from COVID inflation, which was largely in discretionary items like used cars, you don't buy one every month, or fancy toasters or kitchen renos, towards conflict inflation in energy and food, coupled with higher housing costs. That is much more difficult for the consumer to move away from. We've become complacent about the demand destruction elements of high inflation. Now inflation is going to cool on the headline and become more of a growth problem than it is an inflation problem. And that's why that decision-making function from the Fed has the ability to tilt back towards the employment growth mandate. Again, we're not saying no hikes. We're just saying they can't go 9 times this year. Growth is going to be too challenging for that.
Wouldn't you say, though, that the conflict inflation is a sideshow to the real story, which is the labor market? That the most important thing is the trend of wage growth and wage pressures, because that you can see show up in services prices in the future and everywhere across the economy. And we're seeing it broaden, right? It's not just goods inflation. It's inflation in a wide category of services and other areas. So unless the labor market slows down, I don't know why we should expect inflation pressures to moderate substantially.
Well, let's be careful about wages. First of all, wages are not growing fast enough to offset the inflation that we're seeing. As an energy and food make up 12 to 15% of that consumer basket and rising, it's going to be more challenging to move away from. Real wages declining is something that should be concerning all of us. Now, that labor market's very tight, but remember, the labor market is the last to go. It's a lagging or coincident indicator. Initial jobless claims tend to be extraordinarily strong before we hit rough patches. So we need to be looking forward at where consumer sentiment is, what are those leading indicators of retail sales like housing activity, and saying wage growth that we've seen, which is highly segmented into lower income Americans, leisure and hospitality, isn't broad enough or strong enough to give you the lift to offset what's a growth slowdown to come. Not a recession, just a growth slowdown that gives the Fed cover to pivot.
Yeah, and I know, like, all of this classically is absolutely right, but I just wonder, because this is an inflation scare, inflation is what is causing the weakness in consumer sentiment, right? The housing, that was a pandemic story, so it's kind of obvious that would be ending. So if inflation needs to be resolved, then are we supposed to just kind of sit back and hope that it's resolved on its own at some point in the future? If you want to fix that consumer sentiment problem, don't you need to try to get inflation down in order to do that?
Well, that would be desirable, except rate hikes are going to do very little for energy or food inflation. They'll help on the housing front, but only if we get a pivot from the Fed to something that looks more like a soft landing. The Fed is doing exactly what it needs to do. It's orchestrating a slowdown to bring down demand. So all we're saying here is, like, the Fed is going to be successful. It's going to destroy demand, hopefully not too much. That's going to pile on with recessions in China, recessions in Europe, which have very little to do with monetary policy. And combined, that's going to create a slower growth path that says to the Fed, we still need to get back to neutral, but slower and over a period of years. It comes back to the question, how much of this inflation can Fed rate hikes solve? Even Powell told us on March 16th, this year's inflation isn't really what we're targeting. We're targeting longer term inflation. he admitted that's not what we're trying to fix right now. We can't fix right now. That's the Fed message we should take away.
All right, Francis, thank you very much for joining us today. We appreciate it.